Hey, welcome to week 8. So in this week, we will continue with the second part of international parity conditions. So just to recall, last week we looked at the international interest rate parity. So for this week, the focus will be the purchasing power parity and the Fisher effect. Okay. Before we start, if you have started the assignment, if you've got any questions or any clarification, feel free to ask me because I think we're going to have a short class today. Okay, so if there's any questions at all, feel free to let me know. All right, so if there's no more questions, then I will continue with our workshop. Okay. Any questions so far with the first part of this topic? Did we understand interest rate parity? Were we okay with interest rate parity arbitrage? Okay, we're very quiet today. All right, so if there is no questions, I'm just going to continue, okay? There is something in the chat box. Sensitivity analysis assignment, of the assignment, sorry. So in this case, you want to look at different scenarios where your income might change. So I think I explained in the assignment question as well. So you've got to assume if the income changes by 10% up and down, how would your exchange rate exposure looks like, okay? So you vary the income forecast and you see how that affects your foreign exchange rate exposure. We have not reached this point yet. So the question is, have we reached this point? No, not yet. So next week, we will talk about exchange rate exposure. And that is when we'll talk about exchange rate risk management. Okay, so next week will be more relevant to your assignment. But for now, you need to look at the company, you need to look at the industry they are in, because for a part of the assignment, you need to forecast their income, okay? So the question is, at the moment, we can't proceed. That's not entirely right. So at the moment, you can have a look at the company itself, as I mentioned before. You can look at their background, their income, and you can try to forecast their next their income for the next 6 months. Okay. The only thing that you haven't been able to do yet is the option hedge, which is what we'll cover in the topic next week. Okay. Aria Kell asked me, sorry, when will we have our next quiz? I will announce it when the on the Monday of the quiz. Okay, so you've got 2 more quizzes left. Sorry. Okay. Any more questions? So forecasting income is not something we cover in this subject. But if you have done the finance degree, I think that's something that is reasonable to ask from students. So something you can do is you can look at their past performance, look at the growth rate, let's say in the past 5 years or so, and use that growth rate for an estimate for the future. Or if you can look at their competitors, look at their growth rates and use that as your forecast as well. Okay, so I don't expect like a complicated forecasting model. You can just look at the growth rate in the past few years, and then you can compare the company with their peers as well. Okay.
All right, thank you.
Yeah, so it's not too complex. Just look at the past and the peers.
Because the first one was sensitivity analysis, and when I was to start, and I was stuck. We haven't started. We haven't reached that point yet. That's why I stuck.
Yeah, so at the moment, trying to understand the company first. And then next week, when we talk about risk management, then we can go through some details of the assignment a bit more. Okay. Okay. So in this topic, if you have watched the recordings, this is basically the summary of the topic. Okay, so these are all the international parity conditions that we care about in this subject. So last week we covered interest rate parity, which is the relationship between interest rates, so nominal interest rates and exchange rates. Okay. Now for this week, we are looking at the purchasing power parity, which explains the relationship between prices. So here I've got inflation, which is the price change, and exchange rates once again. Okay. The third important parity condition that we talk about is the Fisher effect, which is, I think in some other economic subjects, you have already talked about this. So the Fisher effect explains the relationship between nominal interest rates and the expected inflation rate. Okay. So from these three fundamental international parity conditions, if you combine them together in different ways, you will get the other parity conditions. Okay. So the international Fisher effect, for example, the forward expectation parity, and this is forward PPP. Okay. So one important thing to note is that in here, in this picture, we're assuming that the market is in equilibrium. Okay, so everything is in place, which means that there are some important assumptions to make. So for these parity conditions to hold, firstly, you need a free market, okay? So which means people can trade freely, so that any time when the market is in this equilibrium, people will arbitrage away, and that will eliminate the mispricing, okay? And second, the law of one price should work, okay? And what does that mean by that? By the way, so in the previous slide, we have the exact equations for each of the parity conditions. You can also write them in approximation, which is what we talked about before. So with the exact formula, you're looking at ratios, okay? So you look at the, let's say this one is the expected future spot rate over the current spot rate. With the approximation, you're looking at the percentage change, okay? So here, this is the percentage change, the expected percentage change in spot exchange rates. Here is the differences between the nominal interest rates in two relevant countries, and so on and so forth, okay? So as we mentioned before, sometimes people use the approximate form. That's because it's fairly straightforward to interpret using the approximation, okay? So for example, if the interest rate in Japan is greater than the interest rate in the US, then this difference is greater than 0. That means I would expect the Japanese yen to appreciate relative to, sorry, in this case, I would expect the USD to appreciate relative to the Japanese yen, okay? All right, So let me go through the two important parity conditions that we will focus on today. So the first one would be the purchasing power parity. So the purchasing power parity is a parity condition that is based on the law of one price. And what does this law mean? Okay. So the law of one price is a theory that says if you have an identical good, let's say you've got a MacBook, it should be priced the same. I mean, as a consumer, you would be paying the same for a MacBook, right? Doesn't matter where you buy. Doesn't matter if you buy it from Australia or from China, so on and so forth. Okay. So if a good is identical, then it should be priced the same in different markets, assuming no transaction costs, of course. Why should that be the case? Okay. So in the perfect world where there's no transaction costs, and I know this is a strong assumption. So in a perfect world where you can basically buy and sell goods and services anywhere in the world without worrying about transaction costs, then if there is a difference in prices of the same good in two different places, then you can arbitrage, okay? So you can buy the good at a cheaper price in the cheaper market, and then you can sell it in the overpriced market and make a profit, right? So eventually, if everyone does the same thing, if everyone arbitrages, then the prices of the two markets should go back to be to the same level, okay? So this is the idea of the law of one price. So the implication of the law of one price for international trade is that if you have the same goods and services and you buy them into different places, you should pay the same price for the two assets after adjusting for currency differences, okay? That means, for example, if we look at the US market and the UK market, if I got the same goods that is traded in the UK and in the US, then as a consumer, the price that I pay in pounds should be equivalent to the price that I pay in the USD, adjusting for the exchange rates, okay? So if that is the case, then that means that if I want to find the exchange rate between the pound and the USD, I simply just have to take the ratio of the price traded in the US and the price traded in the UK, right? So if the law of one price works, then the exchange rate between the pounds and the USD should be given by this ratio here, okay? So this is the purchasing power parity. So what it says is that the exchange rate should be set so that the price so that a consumer would pay the same price for the same good in two different places, okay? So one important thing to note here is that here we're talking about nominal exchange rates and nominal prices, okay? So if I extend the same idea for a basket of goods, I will get this equation here. So this is the purchasing power parity for a basket of goods, okay? So the reason why people use a basket of goods instead of just one single good is because sometimes you've got a product that is not traded in different places, okay? For example, a haircut is very hard to trade in two different places. You don't have the same identical hairdresser everywhere. So therefore, to measure consumer purchasing power, normally people will use a basket of goods that are similar in two different countries, okay? So in other words, my exchange rate is going to be determined by the ratio of the price index in country A versus country B, okay, where the price index is an index of a basket of goods. Okay. So, for example, if I got the same basket of goods that I traded at 1,000 yen in Japan and $10 in the US, then to find the exchange rate between the USD and the yen, I will take the price in the US divided by the price in Japan or vice versa. Okay, so in this case, the exchange rate, Japanese divided by USD, is equal to the price in Japan divided by the price in the US. Okay, and in this case is 10. So every USD is worth 10 Japanese yen. Sorry, 100. So every USD is worth 100 Japanese yen. So something to consider as well. So if you have the exchange rate Japanese yen over the USD on the left, then just pay attention to where the price of Japan is and where the price US is. Okay, so the numerator currency should be on the top and the denominator currency should be in the bottom. Okay, just to avoid confusion. Right. So most of the time we would express the purchasing power parity or the PPP in the relative form. Okay. So when we talk about the relative PPP, we're talking about the relative change in the spot exchange rate versus the change in the prices. Okay. So in the previous slide, we're talking about absolute exchange rate values and absolute prices, okay? With the relative PPP, you're talking about ratios. So here I've got the expected change in the spot exchange rate. On the right, I've got the expected changes in the price levels, okay? So pi is the inflation rate, which by definition is the rate of change in prices from one year to the next. Right. So if I rewrite this equation, if I times the both sides of the equation by SD, then I've got this alternative form here. Okay. So this is a formula that helps me compute the expected future spot rate. Okay. One thing to note as well, so because here we're looking ahead, right? So in this equation, we're interested in measuring the expected change in the spot exchange rate from year T to year T plus 1. So the inflation rates here that we are looking at are expected inflation rate, okay? So the inflation rate expected from year T to year T plus 1, okay? So as we mentioned before, with the previous equations that we talked about, we're looking at the changes in the nominal exchange rates and changes in nominal prices, okay? So essentially the PPP states that anytime when you have a nominal or an artificial, whatever you want to call it, anytime when you have a nominal change in the price levels in two different countries, this nominal change should be reflected in a corresponding change in the spot exchange rates, okay, in the nominal exchange rate. so that the real exchange rate remains unchanged. Okay, so in economics, you've got two different concepts. You've got the real exchange rate and you've got the nominal exchange rates. Okay, so nominal exchange rates are exchange rates short-term deviations of the exchange rates, whereas the real exchange rate is something fundamental. Okay, so real exchange rate don't change that much, but nominal exchange rate changes. Okay, so how does the PPP relate to the real exchange rate? Let me pull up a document and show you. All right, so how do we relate the purchasing power parity and the real exchange rates? Or in other words, what is the implication of the PPP for real exchange rates? Okay. So we mentioned before that the PPP reflects nominal changes in the exchange rate as well as the price level. Okay. So if I call E as the expected change in the exchange rate, so here I start with the PPP. Right. So here I just rewrote the PPP as 1 plus E, where E is the expected change in the exchange rate. Okay. So E equals to ST plus 1 minus ST divided by ST. Okay. So if you take 1 plus E and you rearrange, you will find that you will get ST plus 1 divided by ST, which is the original PPP that we saw before. On the right-hand side, I've got 1 plus pi D divided by 1 plus pi F, where D is the domestic country and F is the foreign country. Okay. So nothing new, it's just, I just rewrote the PPP, the relative PPP as we saw before. Now I'm going to call this equation 1. So what I'm going to do next is that I'm going to divide both sides of the equation by 1 plus E so that I get this ratio over here. Okay, so if I take this ratio and I divide it by 1 plus E, I will get this ratio here. So let Q be this ratio, 1 plus pi D divided by 1 plus pi F times 1 plus E. Okay. So as you can see, if the PPP holds, if the purchasing power parity is in equilibrium, then Q will be equal to 1. Okay. So if this holds, if you divide both sides by 1 plus E, you will find that this ratio will be equal to 1. Okay. So when the PPP holds, Q is equal to 1. So Q is what we call the real interest rate, the real exchange rate, sorry. So when the PPP is in equilibrium, your real exchange rate does not change. Okay, so the rate of change is 1. However, if the PPP does not hold, this is when the change in the price levels in 2 different countries are not met by the same corresponding change in the spot exchange rate. Okay, so this is when there will be a real implication for your real exchange rate. So when the PPP does not hold, let me go down here. So when the PPP is not in equilibrium, for example, in this case, if Q is less than 1, right? So when this is the case, you will see a real implication for the real exchange rates, okay? So when Q is less than 1, if we go back to our PPP equation as before, so when this is less than 1, if I times both sides by 1 plus pi f times 1 plus e, then I will get this equation here, okay? So in this case, 1 plus pi d is less than 1 plus pi f times 1 plus e, okay? So what this means for a consumer is that on the left-hand side, I've got the expected price change for a domestic product, okay? So here is the expected price change for a domestic product. On the right-hand side, so here I've got the expected price change of a foreign product adjusted for the exchange rate differences, okay? So for a domestic consumer, if I buy a good from the domestic economy, I expect the price to increase by this much, okay? Alternatively, if I buy an imported good from overseas, this is how much I expect the price to change, okay? So after adjusting for the currency, I expect the foreign good prices to increase by this much. So as the equilibrium, as the equation implies, as the equilibrium implies. So in this case, I expect the prices of the domestic goods to increase a little bit less relative to the prices of the foreign goods, okay? So in this case, if I am a consumer and if I'm very sensitive about prices, I would prefer to buy the goods from the domestic economy, okay? Because I pay less, okay, in the future. So what is the implication of this for competitiveness, okay? So in this case, there is a real change in the competitiveness of the two countries because in this case, consumers will prefer the domestic goods relative to the foreign goods, okay? So the implication here is that when Q is less than 1, the domestic competitiveness will increase, okay? Or the competitiveness of the domestic country increases relative to the foreign country, okay? So the implication here is also whenever there is a disequilibrium in the purchasing power parity, the real exchange rate between the two countries would differ, and there will be a real implication for the country's competitiveness, okay? And vice versa. So if Q is greater than 1, then the prices in the domestic country are expected to increase more relative to the prices of foreign goods, okay? So in this case, the domestic competitiveness would decrease. All right, so where were we? We were here. So in the previous analysis, we have talked about how the purchasing power parity has implications for the real exchange rates. Okay, so we said that whenever the PPP is in equilibrium, then any nominal changes will adjust for themselves. But whenever the PPP is in disequilibrium, this is when there is a real change in the company's, in the country's competitiveness. Okay. All right. So one other thing with the purchasing power parity is that it gives us a formula to forecast future spot rates as well. Okay. So in here, on this slide here, we said that the purchasing power parity implies that the relationship between the current spot rate and the future spot rate is given by this equation over here. Okay, that means if I want to forecast future exchange rates, I can take the current spot rate and I times it by this ratio here. Okay. So for example, if I observe the following data, the current spot rate between the Japanese yen and the USD is currently 90 yen per USD. I also observed that the expected inflation rate in the US is 5% and the expected inflation rate in Japan is 2%. Okay. So in this case, if I think that the PPP holds, then what would be the expected future exchange rate? Okay. So in other words, if I want to find ST plus 1, what would be the value of ST plus 1, given the data here?
Is it 90 plus 1, something like that?
Yeah, well, let me check. Do you have the formula?
No, I'm just saying ST plus 1 would be spot exchange rate plus 1, right? So that's 90 Japanese yen plus 1 into...
No, this is the time, sorry. So this is ST.
Yeah.
This is the current spot rate.
Right.
I want to find the future spot rate.
Oh, okay, yeah. Sorry.
That's okay. So you go back to this formula here and you apply this formula to work out the future spot rate. So what I want here is I want this number, okay?
Sorry, Van. I'm still not getting it. Like, what do we exactly have to do?
So we have to use this information.
Right, that's right.
To compute the expected future exchange rate.
Right.
Okay. So here, if I summarize the information, this will be my current spot rate.
That's right, yeah.
So I'm going to denote it ST.
Right.
This is the expected exchange rate in the future.
Right.
So I'm going to denote it as ST plus 1 for the future. So T is here.
Right.
And T plus 1 is here.
Okay.
Yeah. So we got the ST provided by the question.
Right.
And what I want is I want you to compute ST minus ST plus
ST
1.
Plus 1.
Yeah.
Mm-hmm. Okay.
So what you want to do is you want to start with the relative PPP.
Yeah.
And you want to plug in the relevant numbers in the relevant places.
Right. Mm-hmm.
Okay, so the first thing I would do is I will start with the relative PPP. So in this case, I've got the exchange rate between the Japanese yen and the USD. So Japanese yen over USD. So my relative PPP will be written as follows. On the left-hand side, I've got the expected future exchange rate. On the right-hand side, I've got the current exchange rate times 1 plus pi Japan divided by 1 plus pi US. Okay. So my numerator currency should be on top and my denominator currency should be in the bottom. Okay. So the next step is fairly straightforward. So what I want to do is I want to plug in the correct numbers in the correct places. So here my current spot rate is 90 Japanese yen over USD. I'm going to times it by 1 plus the Japanese inflation rate. So 10.2.
It's 1.02 divided by 1.05, I think.
Exactly, yes. And that will give me a
87.4285.
Exactly. So this will be my expected exchange rate. Okay, so 87.42 something.
Yeah.
Thanks, Enich. So
Thank you.
this will be my expected future spot rate as implied by the PPP. Okay.
Right.
So in your assignment, you're asked to do a forecast of the future exchange rate. So these are some of the ideas that you can do to forecast, okay? So if you could observe the inflation rates in 2 different countries, like say the US and Australia, then you can also use the PPP to form your forecast, okay? So these are a few ideas that you can use for your assignment.
I just have a question regarding assignment that
Yeah, sure.
for forecasting the exchange rates, we would be working it on the Excel sheet, right?
Yeah, exactly.
Right. Okay. We can even do it in regression linear way.
Yeah, so you can, if you want to, yes, that will be good.
Yeah.
Although that's something I don't, it's not the requirement, but if you can do that, that will be a bonus.
Okay.
So,
Yeah.
so I don't really expect any fancy regression forecasting techniques.
Right.
I just want you to understand that there are different ways you can forecast exchange rates.
Right.
And the important thing is to always check whether your forecast is robust. Okay.
Right.
So sometimes different methods might give you different results. And
Right.
if that's the case, what do you do about it? Okay.
Right. And how much like historical data we have to take, like approximately like around 3 years or something?
3 years, 5 years is good for me.
Right.
Yeah.
Right.
So
Okay.
the conventional, if you want to do some forecasts, I think 3 years would be expected.
Right.
Yeah.
Right. Yep. Thank you.
Good question. Thanks, Anish.
No worries. Thank you.
So yeah, so if you do know some forecasting techniques or regression, if you know how to do that in Excel, feel free to do so. That will be great. But doesn't matter what you do, you need to make sure you explain your methodology, okay? You need to tell your reader that this is what I do, this is where I collect my data, this is the regression I run, and this is the output from my regression, okay?
Right. Sorry, Van, I just have one more question.
Yeah, sure, go for it.
I'm a little confused with the dates. Is it all right if I take like somewhere around like, for example, September, 1st of September?
Yeah, sure,
And
that's no problem.
yeah, go back 3 years and take a data and forecast for the next 6 months, that would be March 2021.
Yeah, that's no problem at all. Yeah.
Yep. Thank you very much. Thank you.
Yeah. That's good. We have talked about the purchasing power parity, and as mentioned before, if you want to collect the inflation rates for your forecast in the assignment, you're welcome to do so. Just make sure you explain to your reader what you do. Okay.
Yeah, sure. Thank you.
Yeah. So the next important parity condition that we discuss in this topic is the Fisher effect. Okay. So here we look at the relationship between nominal interest rates and inflation rate. Okay. So the Fisher effect states that the nominal interest rates should be determined by the product of the real interest rate and the inflation rate. Okay. So in approximation, if you expand this equation, you will see that I will equal to R plus pi plus the product of R and pi. So if R and pi are in percentage points, then the product of R and pi are very small. So in that case, you can assume that this is approximately 0, which gives you this approximation here. So in this approximation, it says that the interest rates, the nominal interest rate that you observe, is equal to the real interest rate plus the expected change in prices. Okay. All right. So if we combine the Fisher effect and the purchasing power parity, so the Fisher effect is what we talked about before. So 1 plus I equals to 1 plus R times 1 plus pi, which is the inflation rate. And the purchasing power parity. So purchasing power parity is here. This is the relative form, by the way. So this is 1 plus pi A divided by 1 plus pi B. Okay. So if I combine these two effects, now on the right-hand side, let's look at the right-hand side here. So here, if I apply the Fisher effect to rewrite the right-hand side of the equation, then this is what I've got. So according to the Fisher effect, 1 plus pi will be equal to 1 plus I divided by 1 plus R. Okay. So here I can rewrite this as 1 plus IA divided by 1 plus RA. And here will be 1 plus IB divided by 1 plus RB. Okay, where R is the real interest rates. So if we assume that the two countries have the same, if we assume that the real interest rate does not change too much and the two countries got the same sort of fundamentals, then we can ignore this term over here with the real interest rate, and we can rewrite the right-hand side as 1 plus IA divided by 1 plus IB. Okay. So in other words, if the changes in the real interest rates are minimal, then the right-hand side of the relative PPP could be written as 1 plus IA divided by 1 plus IB. So if that's the case, it will give us this equation over here, okay, where the relative, where the expected change in the exchange rate, so ST plus 1 divided by ST, is equal to 1 plus the nominal interest rate in country A divided by 1 plus the nominal interest rate in country B. Okay. So once again, you can do an approximation, and I show you how to derive from the official form to the approximation form. Okay. So if you write the International Fisher effect in approximation, it once again gives you an easy to interpret number. So here on the left-hand side, I've got the expected change in the exchange rate. Let's call this E. So E is equal to IA minus IB. Okay. So in this case, let's say if IA is 2% greater than IB, that means we expect E to be 2%. Okay. So what it means is that we expect currency B to appreciate by about 2% against currency B, currency A. Okay. Similarly, if we combine different parity conditions together, we will get these parity conditions here. So, for example, if we combine the International Fisher effect and the IRP, so this is the International Fisher effect, which we just derived before, and this is the IRP, right? So if we equate these two together, we will have the forward expectation parity. Okay, so here if the IFE holds, then this will be equal to IA minus IB. With the IRP, this will be equal to IA minus IB. Okay, that means we can equate these two. So with the forward expectation parity, what it says is that the forward premium or discount. So this here, if you recall from week 4, this is what we call the forward discount or premium. Okay, so the forward discount or premium is expected to be the same magnitude as the expected change in the exchange rate. Okay, as this ratio over here. So what it means is that your forward rate, therefore, is expected to be the same as the expected future spot rate. Okay. And this is consistent with the idea that the forward rate is normally used as a reflection of the future exchange rate. Okay. So in the previous few slides, we have talked about all these different parity conditions here. So we mentioned before that these are the 3 fundamental parity conditions that you need to understand. And from these 3, you can further expand into the other conditions. Okay. So you need to understand all these 3 different conditions. Their importance for exchange rate forecasts and how they are related to the other 3 conditions. Okay. So, so the reason why we talk about all these forecasting, all these parity conditions is because one of the major challenges, if you think about it, in exchange rate trading or for an international financial manager is to try to forecast future exchange rates, right? So For example, in your assignment, that gives you a case study of why forecasting exchange rate is important. Okay. So in the past, people have come up with different ways to forecast exchange rates. And if we want to group them into 3 different groups, we have these groups over here. Okay. So the first group is called an efficient market approach, where people believe that the market is very efficient. And so if you want to predict the future exchange rate, the best indicator is from the market itself. Okay, so instead of doing some complicated analysis, you can look at the forward exchange rate, and you can use that as a forecast for the future exchange rate. Because by the forward expectation parity, remember from the previous slide, your forward rate should reflect the expectation for the future exchange rate. Okay. So if the market is very efficient, if all of the information is already incorporated into the forward rate, then the best way to go for forecasting is to look at the forward market. Okay. So if you believe in an efficient market, then just use the forward rate as your forecast. This is a very cost-effective method because all you have to do is you look at the data from the forward market. The drawback is, of course, you need to have an efficient market in the first place. Otherwise, your forecast will be biased. The second category is fundamental approach. So in this case, you think that there will be some fundamentals that determine the exchange rate, and the market somehow undervalue or overvalue these fundamentals. Okay, so if you believe in this approach, what you want to do is you want to build econometric models. So you can run either OLS regression or some other fancy forms of regressions, and you use macroeconomic inputs to forecast the future exchange rates. Okay. So with the fundamental approach, you try to identify the fundamentals or the key determinants of the exchange rates, and you try to improve the models by having more fundamentals or more explanatory variables in your model. Okay. So this is a bit more involved. You've got to forecast your model. You've got to collect data for your inputs to be able to compute your output. The third category is technical analysis. So in this case, you don't believe in a long-term equilibrium, if you want, or you just want to forecast a very short time period. Okay. So in this case, what you do is you identify trends or patterns in historical data, and you use these trends and cycles to predict the future movements of the exchange rates. Okay. So inherent with the fundamental approach and the technical analysis is the belief that the market is not efficient in some form. Okay. With fundamental approach, you believe that the market has not incorporated all the fundamental information yet. And so it's better for you to use econometric models to do the forecast yourself. Okay. With technical analysis, you believe that the market is not even efficient in its weakest form. Okay. Which means historical data are not fully incorporated into the current price, so that there is detectable trends and cycles that you can exploit. Okay. So in the past, people have tried to use data to try to see which forecasting method outperformed the other ones. And what they find, surprisingly, is that most of the time, the forward exchange rate seems to be the best performing forecasting approach. Okay, so this is based on an empirical study. I think that is cited in the textbook. So what people did was they look at the forecasting errors for different methods and they compare the forecasting errors over time. Okay, the idea is if you have the best forecasting approach, then your forecasting error should be very small relative to the other models. And what they find is most of the time the forward exchange rate tend to have lower forecasting errors relative to more sophisticated methods. Okay.
I have a question.
Yeah, sure, Nakis.
In terms of assignment, can we conduct any of these three approaches?
Well, if you want, yes. So if you want to, like Anish said before, if you want to use historical data and run a regression, you can do that, yes.
Or just simply technical analysis, or you need a combination of both?
Normally when I do research, I would do different methods to make sure the results are robust. But in the assignment, I don't expect you to do a lot of different approaches. Just give me one and explain it very well.
All right.
Okay.
So for regression, what can be the dependent variable so we can run a regression on?
So if you want to forecast exchange rate, the dependent variable should be your exchange rates.
So we have to regress that towards something. What are those regressors?
So you have to find out yourselves. Yeah. So that's why I said if you want to do more sophisticated models, it's up to you, but that's not required.
All right.
Yeah. So of course you get bonus points if you put more effort. But if you can show me, if you can apply the formulas that we have talked about in class, like the purchasing power parity, international, the interest rate parity conditions, so on and so forth, for your forecasts, or you can even use the forward rate. Okay, that will be good. So remember with the assignment, there are two main goals. The first one is I want to see whether you can apply this knowledge to a real life case. And second, I want to see whether you understand what you're doing. Okay. So you don't have to be too sophisticated. You just have to be coherent, right? So you need to use an approach that you're confident with and that you can explain to your reader. Okay.
All right.
Of course, if you know other sophisticated methods, that will be encouraged. That will give you more marks, I would say. But if you're not confident with it, stick to something you know.
All right.
Yeah. Okay. Good questions, guys. Now we are right at 3 p.m. So did we want to take a short 5-minute break? And we'll come back at 5 past for the tutorial questions. Okay. So I'll see you guys back in 5 minutes.
Yep, sure. Thank you.
Sure. Thank you.
Thanks, Anish. Okay, so let's move on to our tutorial questions. So for the theory questions, we've got a few today. And for the calculation questions, I don't think today is too difficult. Most of it are just theoretical discussion. Okay. So let's start with question 5. Discuss the implication of the deviations from the purchasing power parity for countries' competitive position in the world market. Okay. So this is what we sort of discussed before when we talk about the PPP and real exchange rates. Okay. So here we talk about Q, which is the real exchange rate or the relative competitiveness between different countries. Okay. So did someone want to discuss this question for me?
I guess it leads to arbitrage.
Yes, can you explain a little bit more?
So the prices are not identical in different markets. So we can purchase from one place and sell it in the other place and make profit.
Exactly. So the arbitrage activities are the reasons why most of the time the PPP holds. So through arbitrage activities, people bring the purchasing power parity back to equilibrium. Yeah, so in that case, if the purchasing power parity holds, what do you think will happen to countries' competitive position?
So I guess if it's the same, if it holds, that's the same prices in different marketplaces.
Exactly, spot on. So if the purchasing power parity holds, it doesn't matter where you buy or sell, you get the same prices. In that case, does a consumer have any preference for any markets at all in terms of prices? So when the PPP holds,
there won't be any preference, because anywhere we buy, it's going to be the same price.
exactly, spot on. So when PPP holds, there's no difference at all because we get the same price. When PPP does not hold, however, what would happen?
The parties will buy from the cheaper market and then sell it in the at the market where we can get the higher price and then make a profit.
Exactly, spot on. And so expensive. Right, so any arbitrageurs who see a difference in prices into different markets will be buying cheap and selling expensive. Even for a normal consumer, if we see prices cheaper in a certain market, we'll go there and consume in that market, okay? So the implication here is that whenever PPP does not hold, that is when you have a change in the competitive advantage of different countries in the world, okay? So this is a bit lengthy, but it's similar to what we saw before with the Q. Remember when we look at this document here? So when your PPP holds, nothing happens. People are happy to buy anywhere. But when your Q is less than 1, or when your PPP does not hold in this particular way, then people prefer your domestic goods, okay? This is when your domestic competitive position increases, and vice versa if Q is greater than 1, okay? Guys, so what it also tells us is that the purchasing power parity tells you the relative the corresponding changes in the nominal values, okay? So any changes in the PPP should be nominal for the purchasing, for the competitive position to stay the same. Question 7. So in this case, the question says that we find that it's normally difficult to forecast future exchange rates more accurately than the forward exchange rate, okay, or the current spot rate. In other words, normally it's very hard to do better than the market. So how do you interpret this result? So if I have 3 different forecasting techniques, forecast 1, forecast 2, and forecast 3, and they are all worse than the market, if I look at this result, what I would think is that it looks to me that the market tends to outperform any individual forecast here, okay? Which means somehow the market is quite efficient, yeah? So when you have an efficient market where all information is incorporated into prices, this is when the market forecasts tend to be outperforming, okay? So in other words, the result tells me that the markets seem to be informationally efficient, meaning all information is already incorporated into market prices, okay? So as a result, unless you have some sort of private information, it's very hard for your forecast model to outperform the market, okay? It could also reflect that transaction costs could be too high for any forecast techniques to be better than the market, okay? Question 10, this is a purely theory question. So this is typically for multiple choice type of questions, okay? So we sort of talked about these before at the beginning of the class. So did someone want to explain to me in their own words, what is the law of one price? So this is the idea underlying the purchasing power parity, right? Okay, I'm going to create a poll question then, since we're a bit quiet today. Okay, I'm going to share a poll question. So which statement is best reflective of the law of one price? So I've got 13 questions, 13 answers so far, and I'm waiting for the other 13. in the polling and share the results. Okay. So I think most people got the answer right. And I'm sorry, this is not the best multiple choice question I can set. So the lot 1 price, by definition, states that the same good should be traded at one single price in different markets. Okay, that means as a consumer, you should be out of pocket the same amount. Doesn't matter where you go to buy the goods or services. Okay. Now, answer B is a little bit ambiguous, I'm sorry. So answer B says that the same good should be traded at different prices depending on currency values. Yeah, if you talk about like dollar price versus pound prices, then the numbers are different. But what I meant here is that the price that you pay, say if I pay $10 in Australia and I get 1 pen, then when I go to the UK and I pay 10 Australian dollars, I should be able to get 1 single pen, identical pen as well. Okay, so that's what I meant by one single price. Answer C is definitely not right. That's because if the goods are produced differently, if you've got different inputs, then they are not identical anymore. Okay, so here we're talking about same identical good. Okay. So it looks like we all got it. Absolute PPP and relative PPP, what is the main difference between the two?
The relative takes inflation into consideration.
Exactly, yes. So with the relative form, we look at the ratio of changes, okay? So here we look at the changes. So we link the change in the exchange rates with the change in the price levels, okay? So here I'm writing a very, I'm not writing the exact form. Okay. In contrast with the absolute PPP, we're talking about the absolute price levels. Okay.
I think absolute. Yeah, I think in absolute PPP, it's like goods are exchanged for 2 different currencies with the same price.
Yeah. I'm just talking about the difference between the absolute
Oh,
PPP.
yeah, sorry.
That's okay. Yeah. So with the absolute PPP, we don't look at the ratio of change. We look at the absolute levels. Okay. So with the absolute PPP, I'm looking at ST and price levels themselves. Okay. So normally we work with the relative PPP because price levels are not something we normally use in macroeconomics, but we use inflation, right? So if you go to the ABS, for example, it's easy to download the inflation rates. Similarly, if you want to do research in the US, if you go to the Federation, the Fed Reserve Bank, you can easily download inflation, okay? So for that reason, most of the time we see relative PPP, okay? Question 11, evaluate the usefulness of relative PPP in predicting movements in foreign exchange rates on a short-term basis versus a long-term basis, okay? So in other words, would the PPP be more accurate over the short term or over the long term? So to answer this question, you've got to read the textbook somehow. So if you have,
I think it is more reliable in the long-term basis because the number of transactions it takes in the duration and then the fluctuations.
yeah, spot on.
Somewhere.
Yeah,
And
yeah.
inflation also, inflation takes place in a long period of time.
Exactly, spot on. So with the inputs for PPP, yes. So the input that we need are a little bit sticky. So it tends to be more for the long term than the short term. Okay. And also, if you think about these parity conditions, they need, so anytime when you have a disequilibrium, you need arbitrage activities to take place. And so you need some time for the market to adjust. Okay. So it's more likely to happen in over the long run relative to the short run.
So it's not useful for short-time analysis, I guess.
Yeah. So 3 months normally is not quite.
It's better to use forward expectation.
Yeah. And it's easier to get as well. So, but for your assignment, just provide some sort of robustness check by providing a PPP forecast as well, right? So it's not too hard, I would imagine. You just need 2 inflations and you need the current spot rate, that's all. So for question 11, normally for the short term, the PPP is not too accurate, but over the long run, it tends to provide a useful prediction, okay? For this reason, if you compare the GDP of different countries, right, over like a 1 year horizon, normally you would adjust the GDP using the PPP exchange rate rather than the rate that you observe in the market, okay? That's because the PPP gives you a good predictor over, let's say, a 1 year horizon, okay? Right, so these are all the theory questions for this topic. So you will find that this topic is a little bit macroeconomic because we touch on mostly macro concepts. For this topic, you need to read the textbook to understand these concepts, okay? Now, coming to the calculation problems. The first problem is problem 6. So here, in this problem, we've got an article that provided some indicators for interest rates in the US as well as in Turkey. So the question is essentially based on the reported interest rates. How do you predict the change of the exchange rate between the US dollars and the Turkish lira? Okay. So given the nominal interest rates in these 2 different countries, what do you think would happen to their exchange rates? Okay.
I think people will take fund from US in a cheaper rate and then invest the money in Turkey and then gain a higher return and then balance the profit out of it. So if the demand for the US dollar goes high in US and then the Turkey's currency may fall against US dollars, I guess.
Yeah, so I agree with the second part. So when your interest rate is too high, that is typically reflecting a very high level of inflation rate. So over time, you would expect your currency value to depreciate.
Yep.
But I don't agree with the first part. So here, you're borrowing from the US and you invest in Turkey, right?
Yep.
So the nominal return might be high, but if you think about the real return, it might not be too high.
Sure.
Yeah, so after you adjust for the currency values, your return might not be too high. Yeah. So don't just compare the interest rates in 2 different countries. You got to take into account exchange rate risk as well.
Yeah, sure. Okay.
So yeah, so in Vietnam in 2003, there was a period where our inflation rate was 23%. And that was when the economy wasn't doing too great. So yeah, so nominal interest rates, if you have a high level of nominal interest rates, it might not be a very good thing because it might reflect hyperinflation, okay? In which case the country might be printing too much money, and that creates a very high inflation rate, okay? So if we apply the international Fisher effect here,
Excuse me.
yes, Vivek?
I have a quick doubt. Shall I assume that the more the interest rate is less, the country is doing better?
Well, it's not as simple as that. So with interest rates, normally, say the Australian central bank, for example, when the economy is not doing too great, they also cut the interest rates, right? So when the interest rate is too low, that could also be an indicator of the economy doing not too well. But if you see a very high interest rate like this, like 70%, that is definitely not a good thing.
Got it, man. Thanks.
Yeah? Does that
Got
make
it.
sense?
Yeah, sure.
So normally, if the interest rate is this high, then and this is nominal interest rate, then there's something wrong with your inflation rate. Okay. All right. So going back to the question, so if we use the international Fisher effect, if we go back to our previous slide at the start, right. So what we want is we want to compute the expected change in the spot exchange rate. In other words, we are interested in this ratio here. If we want to work it out from the nominal interest rate, the relevant parity condition that we're looking at is the international Fisher effect. Okay. So going back to our question before. 6. Nekis says, would you please explain Fisher effect a bit more? I'll come back to that later on. Let me just finish this question first. So if I apply the approximation form of the international Fisher effect, so here I've got the expected change in the exchange rate, right, which is given by this ratio here. It will be approximately the difference between the interest rates in the US versus Turkey. So in this case, the exchange rate I'm talking about is the US over the Turkey lira, okay? The US on the left and Turkey lira is on the right. So essentially what this equation tells us is that the expected change of the value of the Turkey lira in the USD is minus 64.07%, okay? So what it says here is the Turkish lira is expected to depreciate by about 64% relative to the USD, right? Okay. So in other words, if we invested in Turkey at the start, then later on when we convert it back into the USD, which is our, assuming that's our home currency, then our investment will depreciate by a lot, okay, by about 64%. All right. So that was problem 6. So problem 6 illustrates how you can use different parity conditions for your forecast, okay? I'm going to go back to the Fisher effect by requests. So Nekis requested me to discuss the Fisher effect again. So the Fisher effect is an equation that explains the relationship between nominal interest rate, which is I. So here on the left-hand side, I've got the nominal interest rate. And on the right-hand side, I've got the real interest rate, which is R. And the inflation rate, which is pi here, okay? So the Fisher effect states that your nominal interest rate should be close to the sum of the real interest rate plus the inflation rate, okay? In other words, whatever you observe in the market, right? So if you go to the bond market and you observe a certain rate, certain yield, that will be your nominal rate, okay? So the real income that you earn or the real interest rate that you have to worry about is actually the difference between your nominal rate that you get from the market, that you observe from the market or a bank, for example, and the current inflation rate, okay? In other words, any price changes, if you have a very high level of price changes, it will be bad for your investment because it means that your real investment will be much lower, okay? Does that make sense, Nekis? Or do you want me to go through it again?
Yes, thank you.
All right, so moving on to question 7. So in November the 1st, 1999, the exchange rate between the Brazilian real and the USD is 1.95 real per USD. The consensus forecast for the USD and Brazil inflation rates in the future for the next 1 year period is 2% and 20%, okay? What would you forecast the exchange rate to be around November the 1st, 2000? So here I'm looking at a 1 year horizon from November the 1st, 1999 to November the 1st, 2000. So as I'm standing here, the current exchange rate is 1.95 real per USD. I also forecast the inflation rates in the relevant 2 countries over the next year to be.
Sorry, I think it's around about 2.280.
2.280.
Yeah.
Yep. So that's your
Answer.
Yep. Okay. 1 second. Let me finish writing down.
Yeah, sure.
So I want to find the future spot rate here. Okay. So here, what parity condition do I use? Interest rate parity, international Fisher effect, purchasing power parity, so on and so forth. Which one should I look at? So here I'm trying to I'm trying to compute the expected future spot rate, right, from the inflation rate. So the parity condition I'm looking at is the purchasing power parity. Okay. All right, so Anish, can you help me with the formula here?
Yeah, I use it like Brazilian dollar into 1 plus pi, mm, 1 plus pi of Brazilian interest, like 20%, divided by 1 plus pi of US percent.
So 2.6%.
Yep.
And
Into 1.95.
1.95. Yes,
Yeah.
exactly. So
That's,
here,
yeah.
what's the number here?
It's 2.280.
2.280.
Yep.
So let me write it down here. $2.28, yes, exactly. So 2.28 real divided by USD. Spot on. So what does it mean? What does this number tell you? So which currency has appreciated and which currency has
US
depreciated?
currency has appreciated, yeah.
And yeah, Brazilian has been got depreciated.
Exactly, spot on. So USD value has increased relative to the real, so the USD appreciates, which also means that the Brazilian real is expected to depreciate. Okay. So the implication here is if your inflation is too high, then your currency value will be adjusted downward, okay, to make sure that the prices in the two different countries are back to equilibrium, okay. So high inflation will lead to depreciation of currency. Okay, that's good. We're doing very well with time as well. So problem 10. So in this problem, we are given two countries, the US and the UK. In the US and the UK, in this case, the real interest rate is 2.5%. So here, R, which is the real interest rate, is 2.5 for US and 2.5 for UK as well. The annual inflation rates in the two countries are forecast to be 3.5 in the US and 1.5 in the UK for the next 3 years. That means every year we expect the inflation rate to be 3.5 for the US and 1.5 for the UK. And that continues on for the next 3 years. The current spot exchange rate is $1.5 per pound. The question here is to compute the nominal interest rate per annum in both the US and the UK, assuming that the Fisher effect holds. Question B, what is your expected future spot dollar pound exchange rate in 3 years from now? And question C, can you infer the forward dollar pound exchange rate for a 1-year maturity? Okay. So I'm going to share a whiteboard and I'm going to copy the question there. Okay.
Van, I just have a quick question.
Yeah,
That
sure.
this problem number 10 is from a tutorial, right?
Yeah, exactly.
Yeah, okay, thank you.
Yeah. Yeah, it's from the tutorial question. So question A is a very straightforward question. So here you just have to apply the Fisher effect to compute the nominal interest rate, I, okay? So if I write down the Fisher effect in its official form, it reads like this, okay? Where I denotes the nominal interest rate, R is the real interest rate, and pi is the inflation rate. So for the US, I've got 1 plus I US equals to 1.025. Right, the real interest rate in the US is 0.25, 0.25, sorry. And then the inflation rate in the US is 3.5%. So I'm going to times it by 1.035. Okay. So that will give me 1.0608. Okay. Zero, 9 to round it up. That means the nominal interest rate in the US is expected to be 0.0609 per year. So if I do the same thing for the UK, what would be my answer?
So over here, to find out US interest rate, we took 1.025, that is 2.5% of UK, real UK, right?
Yeah, exactly.
Into interest rate of US, that is 3.5% per annum.
Yeah, so you're talking about the nominal rate for the US, yeah?
Right, yeah.
Yeah, exactly. Yeah.
Mm-hmm. And now we have to find the same for UK.
Exactly, yes. So I want to find the nominal interest rate for the UK.
Mm-hmm. Okay.
Is it 1.0403?
Exactly, yes, yep. So for the UK, I'm doing basically the same exercise. I'm going to times 1.025, which is the real interest rate, with
To 1.015.
exactly.
Okay. Oh, okay, okay.
And then I'm going to
Right.
minus 1. And that will give me this number here.
Why are we subtracting 1 now?
Oh, that's because if you look at this equation here, this is the Fisher effect. So on the left-hand side, I've got 1 plus I. So to find I need to subtract 1.
So that one on the left side will come on the right side, so that will become a minus here.
Exactly, yes.
Okay, makes sense. Thanks.
All right, well done, guys. We have finished question A. Now, question B is, what is your expected future spot dollar pound exchange rate in 3 years from now? Okay, so it's a little bit tricky because of the time horizon. Okay. So once again, if we have the inflation rate, we can use the purchasing power parity to compute our expected future exchange rate. Alternatively, for this question, because you have already computed the nominal interest rate in question A, you could also use the International Fisher effect as well. Okay. For consistency purposes, let's use the relative PPP for question B. Okay. But once again, it will be the same if you use the International Fisher effect. So in this case, I want to find the expected future exchange rate. So using the PPP, I'm going to start with the PPP equation first. So on the left-hand side, I've got ST plus 1. Sorry, ST plus 3 in this case. So here, 3. On the right-hand side, I've got 1 plus inflation in the US divided by 1 plus inflation in the UK. Okay. Now, this equation is not complete. Can someone tell me why?
It's within 3 years horizon.
Exactly, spot on. So on the left-hand side, I want a 3-year interest. I want a 3-year exchange rate. But on the right-hand side, currently I only have the yearly or the annual inflation rate, right? So it's not consistent between both sides. So what do I need to adjust to make sure that this is a 3-year horizon?
Maybe multiply by 3.
Close, but not correct.
Mm-hmm.
So you have to think about the way inflation grows, okay? So the way inflation grows is that now, let's say in year 0, at the current time, the current price is $1, okay? So over the next 1 year, the inflation grows by pi, which is the price growth rate, right?
Right.
So by the end of year 1, your price level will become $1, which is the original price, times 1 plus pi.
Okay.
Okay. Now, over the next year, price levels increase by pi again, right? So your price grows by pi again.
Okay.
which means this amount is going to grow to be $1 times 1 plus pi, which is the original value at year 1,
All right.
times 1 plus pi. Okay.
All right.
In year 3, this amount is going to grow to, as you can guess,
1 multiplied by 1 plus pi, 1 plus pi, 1 plus pi. Yeah.
exactly, right? So it grows by 3 times by the end of
Right.
year 3.
Right.
So from $1 that you start in year 0, at the end of year 3, you will get $1 times 1 plus pi to the power of 3.
What if we just take number 3 instead of 1, like 3 plus pi US?
So which one is it?
No, over here in the equation, 1 plus pi US. Instead of 1 plus pi US, what if we take 3 plus pi US over there?
That would not be correct by this analysis here.
Okay.
Yeah, so it's not the same. It's not consistent. Yeah,
Okay.
yeah. So, yeah, so by this analysis, your price levels will grow at a compounding factor.
Okay. Yeah.
Okay, yeah. So, which means that by the end of year 3, your inflation factor should be 1 plus pi to the power of 3.
Right.
Right, so here you got to adjust the right hand side.
Oh, 3, right.
Yeah.
Okay.
So if we put in the correct numbers in this calculation, so here I want ST plus 3. So I'm going to rearrange this equation so that ST goes to the right. Right, so I'm going to times both sides by ST. And then I'm going to replace the numbers in the correct places. Okay.
$1.5295.
1.529.
Yeah.
1.5. I've got a slightly different number. Could be because I didn't round.
Yeah, like I round the number, so I got this.
Okay. Yeah. Did everyone else get the same number? 1.529? So the number that I got is, can you see my calculator here? Just gonna share the screen. See, yeah, so Lom got the same answer as me, so 1.59. So Vivek, you want to check your answer again? Because I got 1.59 as well. I'm going to put a question mark here. The answer I got is 1.5904. Okay. All right.
So, ma'am, while calculating, I shall be taking a full figure, right?
Yeah. Even if you
Yeah.
keep 4 decimal places, I think it should be close by. It should be close to 1.59.
Yeah, I think, I didn't put that, so maybe.
Did
I
you?
was calculating in my phone, so for that sake, I don't remember what the huge number is, so I just only take 2 or 3 digits.
Oh, okay.
To the
But
point.
did you take the power of 3?
Yeah, I
Okay.
did.
Okay. Yeah, so it could be a rounding factor then.
Yeah.
Yeah. So here in this calculation, I didn't round. I just used the number from the calculator. All right. So let's move on to question C, and then we can take a short break, okay, afterwards. So question C, can you infer the forward dollar-pound exchange rate for the 1-year maturity? This is relatively easy, given what we have done in questions A and B, okay? So here what I want is I want a forward rate. And if I go back to my lecture slide, so what I want is the forward rate, which is in this circle here. And what I'm given is I'm given the inflation rate, right, in the question. So the relative, the corresponding parity condition that I should use is the forward PPP, which is simply just F divided by S equals to 1 plus pi A divided by 1 plus pi B. Okay, so it's pretty much the same as the PPP, except that you change the expected exchange rate to the forward rate. Alternatively, you can also use the IRP, given that you have calculated the interest rate in question A, right? So you can use the IRP as well, and you should get the same answer, okay? So here, going back to the whiteboard, for question C, if I want to compute the forward exchange rate for 1 year, this is how I'm going to write the equation, okay? So here I've got the forward dollar-pound exchange rate on the top, and then I've got the current spot rate. On the right, I've got 1 plus inflation US divided by 1 plus inflation UK. Okay. Now, since this is only a 1-year maturity, I do not have to worry about the time differences. Okay. So here, I'm just going to keep the equation as it is.
It is 1.52955, I guess.
Hang on 1 second, let me check. 1.529. Yeah,
55.
Exactly. Yeah, I've got the same answer as well.
Yeah.
So here I've got 1.95, which is my current, oopsie, this is 1.50. So the current spot rate is 1.5. I'm going to times it with 1.035 divided by 1.015. That will give me 1.5296. Okay. Dollar over pound. Okay.
Ma'am, here the dollar has depreciated, yeah?
So the dollar has, yes, the dollar has depreciated. Yep.
All right.
Yeah, so the pound value has increased. Okay, did we want to take a short break for 5 minutes and we'll come back at 10 past for the last two questions? Okay.
Yeah,
Okay, so I'll see
Yep.
you in
Thank
5
you.
minutes.
sure. Thank you.
Okay, let's come back and finish the last two questions. So in problem 12, we're looking at an IRP arbitrage question, right? So here we've got a spot exchange rate, a forward exchange rate, and two interest rates in two different countries, okay? So this is something that we did from last week. So can you help me solve the problem here from start to finish, okay? So in question 8, you've got to check whether the IRP condition holds or not, which means whether you have arbitrage profits or not. Second, you need to devise a strategy starting with $1 million and work out the profits you can earn from the strategy. Okay. So I'm gonna copy this table to the whiteboard and we can do the question there. Okay. So if I want to check the IRP condition for this question, what will be my equation? Okay, so this is what I'm going to start with. So I'm just going to replace the numbers into the correct places. So here my forward rate is 1.1922. My spot rate is 1.2051. On the right hand side, I've got 1 point. Now this is the yearly rate, and what I want is I want a 6-month interest rate, right, to be consistent with my forward rate. So what I need to do is I need to divide these two rates with 2, right? So on the top, I've got the interest rate for the Swiss franc. So here that will be 1.01. So 1 plus 2% divided by 2. In the bottom, I've got 1 plus IUS. So in this case, it will be 0.125. Okay.
For the interest rate of franc, it would be 1.02, right? It's 2% for franc per annum.
Yeah, but you want to take the 6 months rate because your forward rate is 6
Oh, yeah.
months.
Sorry. Yeah.
That's okay.
right.
So I'm going to rearrange just to look like, because the last time when we did the IRP, we had this equation here, right? So F divided by S times 1 plus IUS equals to 1 plus I Swiss franc. Okay, so this is what we did last week. So to be consistent with the way that we solved the problem last week, I'm just gonna do the same thing. Okay, so on the left hand side, I've got so 1.1922 divided by times. So this is
1.1921.
and I've got a little bit different answer.
Oh, sorry.
That's okay. I might be wrong. So I got 1.0016.
1.0016. Okay. Yeah, 1.0016. Yeah, that's right.
Okay, that's good then. So that means this is less than the right hand side, right? So the left hand side is smaller than the right hand side. Okay. So this term here is lower than this term. So if that's the case, and if I want to arbitrage, I want to be lending in the franc and I want to be borrowing in the USD. Okay, as implied by this IRP here. So it looks like it's more expensive for me to lend in the franc, and then I'm going to borrow from the USD. Okay. So based on the analysis that we just did before, we have decided to borrow US and then lend. Okay. So if I want to construct a strategy, a step-by-step strategy, I'm going to start with borrowing money in the US. Okay. So the question gives me $1 billion to start with. So I'm going to borrow 1 billion USD at the US interest rate. So 1.25% per 6 months. Okay. So in the next step, and of course, I'm going to have to compute, I'm going to have to pay back my loan later on after 6 months, but that's something we'll compute later. So once I've got the money I borrow in the first step, I'm going to convert it into the franc so that I can invest in the Swiss franc. So I'm going to convert at the spot rate, right? So because I convert the currencies today. Okay. So from 1 million USD, I can convert it into 1 million times 1.2051. Okay. I would then want to use this money to lend as I originally planned. So I'm going to invest, I'm going to lend the Swiss franc at the franc interest rate, which is 1% per 6 months. Okay. So in the future, in 6 months' time, I expect to get my, sorry, this is 205, 100. I would expect to get the future value of this amount, okay, in the franc. So also because I know that this is a future return, right? So I'm going to receive this much of Swiss franc in 6 months' time. So I don't want to be exposed to exchange rate risk. And as a result, I'm going to lock in an exchange rate to convert this much of franc back into the USD, okay, at the current time, which means I'm going to be selling this much of franc forward, okay? So I know that I'm going to convert this franc back into the USD. So I enter into a contract that allow me to sell these franc forward, okay? So Anish, do you have a question?
No, I think it would give us a profit of $20,928.53.
A little bit different from mine. Let me,
Yeah, sure.
yeah, let me finish this calculation and then we can come back.
Yeah, sure.
Right. So I'm going to sell this franc forward at a rate of 1.1922. So if I convert this much of franc into the USD at this rate, this is how much I get. Okay. So this is the USD equivalent of my investment in the franc. Okay. Now to compute the investment return or our net profit, we are going to need to deduct how much we earn with how much we have to pay in our borrowing costs, right? So in step 1, remember we borrow 1 million USD at 1.25 for 6 months. That means in 6 months' time, we have to pay back 1 million times the interest rate, right? So 1.0125. So that will be this much. Okay. So if I compute the difference between how much I earn in step 4 and how much I have to pay in borrowing costs from step 1, the net profit that I get is about 8,429 USD, right? Anish, did you see where the answer is different?
Yeah, actually, I didn't took the 1.25 interest rate, so I just
Oh, okay.
instead here. Sorry.
That's okay.
Yeah, thank you.
Good. So we have worked through question 12, similar to what we did before last week. Okay. So this is an arbitrage strategy, which means with this strategy, we don't have to commit any capital. Okay. All the transactions finance themselves. Second, we don't expose to any risk, right? So we hedge our exchange rate risk using the forward contract in step 4. And finally, we earn a profit, which is about 8,000, which is in step 5. Okay. Okay, so let me share the notes with you guys and then we can move on to the next question. Okay, so question 12 is done. Only one more question to go. Okay, so moving on to question 8. Now, question 8 is not very hard. The hardest question is actually question A, part A of question 8, right? And the other ones are quite easy. Now, this question is taken from a CFA exam, right? And this is how the question goes. So here you've got information, some macro information about 2 different countries, the US and South Africa. So you're a fund manager and you need to compute the following. Number 1, you need to compute the current ZAR spot rate. So ZAR is the South African rand. So you need to compute the current ZAR spot rate in the USD, which means you need to compute this, right? So USD over ZAR. That would have been forecast by the purchasing power parity. Okay, so what is the implied exchange rate by the purchasing power parity? So here you will need price or inflation. Question B, using the IFE, International Fisher Effect, what is the expected ZAR spot rate in the USD 1 year from now? So here you want to compute S1, USD over ZAR for the next year, okay, using IFE. So when you see IFE, you're using the interest rate, right? Let me check if that's interest rate or not. So yeah, so you're using the interest rate to compute the expected spot rate. Question C, using the purchasing power parity, the expected ZAR spot rate in the USD 4 years from now. Okay, so here you want to compute S4, USD over ZAR, using the PPP. Okay, so with PPP, you're looking at interest rates, inflation rates or prices. Okay. Now, these questions are independent, so I want you to try question B and C first, and then we can come back to question A, okay? Question A is easy, but it's a little bit tricky with the information, that's all. So help me with question B and C, guys, and then once we've done these two questions, we will come back to question A, okay? I'm gonna keep the slide on here so you have the information you need. And once we are ready, we can go to the whiteboard, okay? So I'm gonna help you by writing down the IFE and the PPP. Oopsie, IFE. Okay, are we ready? Let me go to the whiteboard, okay? So, let's start with question B, guys. So in question B, I want to use the IFE to forecast the 1 year exchange rate, okay? So I've got ST plus 1 equals to ST times 1 plus I. Now, the exchange rate that we are dealing with is the USD or even ZAR exchange rate. All right, so it says the current ZAR spot rate in the USD, which is this one. So the USD is on top, so I'm going to write US divided by 1 plus I ZAR or South Africa. And then I'm going to plug in the relevant numbers. So here, what is my current spot exchange rate? That will be 0.158. Okay, so this is my current spot exchange rate. Now, if I look into the table, the interest rate in the US is 10%, so 1.1. And the interest rate in South Africa is 8%, so 0.08. Okay. So if I put it in the calculator, I will find that this is 0.1609 USD per rand. Right. So this is fairly straightforward. So you just have to apply the international Fisher effect to compute the expected future spot rate. Okay. With question C, it's similar. So here I'm going to apply the PPP to compute the future spot rate. The only difference here is I'm looking at 4 years from now, right? So as we said before, if we look at the 4-year horizon, our prices grow by a factor of 4. That means we need to take the power of 4 for our inflation rate, okay, to adjust for the time. So I'm going to start with the same equation. Okay. Here I've got the inflation rate for the US, given that the US is on the left. And then I've got the inflation for South Africa, which is on the right. So here. And then I'm going to adjust for the time. Okay. I'm going to take it to the power of 4. So the current spot rate, once again, is 0.158. And then I'm going to times it by 1.07, which is the expected inflation in the US, divided by 1.05, which is the South African inflation rate. I'm going to take it to the power of 4. I'm going to put it in the calculator. And what do I get here? What is my answer for question C?
0.1703.
Exactly, right. Spot on. I've got a slightly different answer, but I think it's the rounding thing.
Yeah.
So 0.1704 or 3, I think I rounded up. So here, this is the answer for section C, right? So questions B and C are typical candidates for multiple choice questions, right? So it's short and it's quite straightforward. You just got a formula and you apply it into the calculation. Okay. Question A is a little bit tricky because just in terms of the wording and in terms of how economists record data, right? So if I go back to the question. So question A says that we want to compute the current ZAR spot rate in the USD that would have been forecast by PPP, right? So here we're talking about the past, not the future, right? So this is time 0. In questions B and C, we have forecast the exchange rate for the 1-year horizon and the 4-year horizon. So what question A is saying is that it asks us to compute the value of the exchange rate at time 0 as it would have been forecast by the PPP over some time in the past. Okay. So here is the PPP forecast of the current exchange rate using past historical data. Okay. So given that we're computing a number from past data, anything that is related to expected information is going to be irrelevant. Okay. That's because for these expected data, it's forward looking, but what we want to compute is we want to compute something that is in the past. So therefore, the information that is related to question A are these ones here, these rows here, okay? So here you've got the base price level, you've got the current US price level, you've got the current South African price level, you've got the base rand spot exchange rate, right? And then this is the actual exchange rate that you observed today, okay? This is not very relevant as well because you want to forecast this rate given the past information, okay? So now I want to use the PPP, right? And if I look at the past data, what I've got here are the price levels, not the inflation rate, yeah? So the correct PPP form that I'm going to use is going to be the absolute PPP, okay? So here I'm looking at the absolute PPP. Let me go back to see what it is. So this is the absolute PPP, okay? So with the absolute PPP, this is how my equation looks like. Okay. So I need the price level in country A and the price level in country B to be able to compute the spot exchange rate. Okay. Now there is one extra complication, which is that the information in the question gives us the base price levels relative to the current price levels. Okay. So which means that this is these price levels are not absolute prices. These are index prices, okay? That means these numbers are not true dollar or ZAR numbers. These are numbers relative to the base, okay? To illustrate what I mean, I'm going to go to the whiteboard. So this is something similar to the idea of computing the consumer price index, okay, or computing the inflation. So you would choose a base year. let's say I'm going to choose 2010 as my base year, and we are now in 2020, right? So suppose that the price level, the absolute price level in the US in 2010 was $20, okay? And then in 2020, the price level increases to $40, okay? Now, if I want to index the price levels in the US, and I'm going to set the base year at 2010, that means for the base year, I'm going to set the price index at 100 points, okay? So I'm going to regard the price index in 2010 at 100 as 100 points. And then I'm going to compute the relevant points for the next few years relative to the base, okay? So if $20 is equal to 100 points, that means $40 will equal to 100 times 40 divided by 20, which is 200 points, okay? So this is what the base price means. And this is what the information in the question gives you, okay? So in the question, it does not give you a dollar number for the price level. It gives you the base, okay? So the numbers that you see are points, not actual dollar figures, okay? So as a result, now, so the base that we are given in the question is 100. The current US price level is, I think, 100 and, let me have a look. 110, sorry, 105. Okay. That means the difference between the current price level and the base is 105 divided by 100. For the South African rand, so for the ZAR, the base is also 100 and the current price level is 111. Okay. So here the relative change between the current price and the base is 111 divided by 100. Okay. So if you take the two ratios and you divide them by each other, so if I take the base, if I take the relative price level in the US, I divide it by the price level in the ZAR. This will give me a ratio of 105 divided by 111. Okay. So to apply the PPP in this case is not as straightforward as before, where you just put the absolute prices on the right and you compute the spot exchange rate on the left. Okay, so in this case, because you're dealing with relative prices, you've got to do one extra adjustment. Okay. So here, what I want is I want to compute the exchange rate, the spot exchange rate. And instead of just relying on the price levels as in the equation, I have to do one extra adjustment, which is to multiply the price ratio with the base exchange rate. Okay, so here I'm going to write base spot exchange rate. So a similar idea applies here. So if I apply the PPP in this case, I'm going to get a point that reflects the relative value of the exchange rate that I want to compute and the base exchange rate. Okay, so in other words, This number gives me the ratio of how much the spot exchange rate should be in terms of the base exchange rate. Pretty much similar to what we talked about before here. So as a result, if I want to find the absolute exchange rate, I need to take this ratio and I times it by the base exchange rate. Okay. So in this case, my exchange rate is therefore going to be 110 divided by 111 times the base spot exchange rate, which is 0.175. Okay. So if I put it in the calculator, this will be 0.1655. Okay. So this is the current spot exchange rate that would have been forecast by the PPP. Okay. So in this question, it's not very hard, but it's just a bit tricky to get your head around the idea of relative prices and absolute prices. Okay. So bear in mind when you have the base price level, and your current price is set against the base, then these are not absolute prices, these are points. And you've got to compute the relative prices accordingly. Okay, that is all the questions that we have today. Any questions at all, guys?
No.
Okay. Alrighty,
Thank you.
so no worries. I'm gonna save this and I'm gonna share the notes with you guys. As usual, if you have any questions, feel free to email me or you can ask in class next time, okay? Once again, I think it's a good time to start your assignment. And if you have any questions with the assignment, feel free to ask me as well. Other than that, I will see you guys next week. Okay?
Have a nice day.
You too. Avinash, when do we have the next quiz? I'll announce the quiz on Monday, on the week that you have the quiz. Okay. All right, I'm going to conclude the class. Thanks, guys. I will see you next week.